Hello, everyone. This is Amira Blake. Today, I'm going to walk you through what's been happening in Iraq's banking world, the rumor that rattled the market, the big new rules for banks, how those rules could change the value of each bank's stock, and how outside experts like Oliver Wyman and JPMorgan are playing roles that investors should pay attention to. Not long ago, the Iraqi stock market, that's the place where people buy and sell pieces of companies, suddenly dropped. The reason was a rumor. People were saying that the Bank of Baghdad had been stopped from handling US dollars. Now, the Bank of Baghdad isn't just another bank, it's one of the largest and most influential in the country. When its shares move, other stocks tend to move with it. That rumor spread quickly. Investors got nervous, sold their shares, and prices dropped across many sectors. But here's the truth. The Central Bank of Iraq, which is like the boss of all banks, stepped in quickly and said the rumor was false. The Bank of Baghdad also confirmed that everything was normal and that they were still doing business in US dollars. Once that was clear, prices recovered and the market calmed down. That was the quick storm. But there's a bigger, more important change happening. The central bank has told every bank in Iraq they must have at least 400 billion Iraqi dinars of their own money set aside, up from the old level of 250 billion. Why does this matter? Think of a bank like a jar that holds not only its own money, but also the money people deposit. A bigger, stronger jar is harder to break and can handle more weight. By raising this minimum, the central bank is making sure banks are sturdy enough to survive tough times and keep people's money safe. This new rule touches some very big names. Rafadain Bank and Rashid Bank are being reshaped into a new bank called First Rafadain Bank with even more capital. The Industrial Bank, Agricultural Bank, Real Estate Bank, and the Trade Bank of Iraq are also part of the reform. International experts like EY, Oliver Wyman, and KPMG are helping to reorganize, improve systems, and meet global standards. Here's where Oliver Wyman comes in. They're a top global consulting firm that works with big banks worldwide, sometimes even on joint projects with major players like JPMorgan. When a bank hires them, it sends a strong signal to investors. We're serious about improving and meeting international standards. Oliver Wyman brings proven strategies in risk management, compliance, and modern banking technology. That kind of guidance can boost investor confidence. And that confidence can help a bank's stock price, especially if improvements are clear and measurable. And speaking of JP Morgan, they have a history in Iraq's banking system too. They played a key role in helping launch the Trade Bank of Iraq years ago, setting up the systems that handle trade and international payments. Even today, JP Morgan keeps a connection with Iraqi banking through correspondent relationships and awards that recognize excellence in cross-border transfers. More recently, Iraqi leaders have been in talks with JP Morgan about expanding cooperation, from helping with large-scale investment projects to supporting digital finance. For investors, seeing a name like JP Morgan involved adds another layer of credibility, making it more likely that foreign capital will feel comfortable entering the market. Now, let's talk about how the 400 billion increase itself can affect stock prices in plain language. When a bank raises more money for itself, here's what usually happens. In the short term, if they raise that money by selling new shares, there will be more shares on the market. Just like adding water to soup makes each spoonful a little weaker, adding more shares can make each one worth a bit less at first. This can cause the price to dip. But in the medium to long term, if the bank uses that extra money wisely, making more loans, improving its services, and building trust, it becomes stronger and more profitable. That can attract bigger investors, increase confidence, and eventually push the stock price higher than before. Banks that meet the 400 billion goal quickly and use the money well may see their prices bounce back faster. Banks that struggle or delay might see their prices stay low until investors are convinced they're on track. So the short version is, short term, prices can drop when new shares are issued. Long term, stronger banks can see prices rise if they use the capital to grow and stay stable. Winners, those that act early and smart. Laggards, those that delay or waste the opportunity. Now imagine this. The new First Rafadain Bank starts fresh, attracts a strong international partner, and private banks that hit the 400 billion goal early get better links with banks overseas. Add in the stamp of approval from advisors like Oliver Wyman and the involvement of a global heavyweight like JPMorgan, and you've got a recipe for higher investor confidence, more stable profits, and better dividends for the strong players. And I'd like to hear your thoughts. Which bank do you think will be the first to reach that 400 billion goal? And which one might have to merge? Share your answer in the comments, and I might talk about your choice in my next video. Before we wrap up, I want to remind you, this is not financial advice. I'm not telling you to buy or sell anything. This is simply information to help you understand what's going on in the market. If you found this helpful, please like the video, share it with a friend, and subscribe so you'll get the next update as soon as it's ready. Tap the little bell to get notified. I'm Amira Blake, and I'll see you in the next one.